Hi, welcome to Magpie channel. I'm Anthony Tran, Magpie Invest Strategist. Today, I'm going to talk about value investing, which is something I'm really passionate about, as value stocks tend to outperform during economic distress. The question is, how investors can uncover such value gems? In the first part of the video, I'll discuss what valuation metric an investor can use to identify an undervalued stock. And in the second part of the video, I'll talk about a value stock that we favor and the reasons behind it. There are two key factors, the first of which is profitability of the underlying company, and the other factor is how investors value that profitability. One way in which to measure investors' perception of a stock is the price-to-earnings ratio, or the PE ratio for short, which is a metric to express how much investors are paying for every $1 of earnings per share. For example, if a company's shares are trading at $100 and its earnings per share is $5, then its PE would be 20. That means a buyer of the share is investing $20 for every $1 of earnings. A high PE usually implies an expensive stock, while a low PE suggests an oversold stock. However, the difficult part is that there are arbitrary cutoff levels that define whether a PE is high or low. Generally speaking, a simple way of assessing a company's PE is to compare a company against its own historical PE ratios. This is particularly relevant for conglomerates or companies with a unique business that is hardly comparable with other companies. Sure, we can look at a comparison between PCCW and China Mobile, both of which are leading telecom services providers listed in Hong Kong. Shares of PCCW are now trading at a forward PE of 33 times, which is apparently higher than that of China Mobile. If one were only to compare the PE ratio, PCCW is definitely overvalued, while China Mobile is undervalued. Upon closer inspection, however, the two telecom players are of different pedigrees, and such direct comparison is not fair. PCCW operates mobile network and broadband services in Hong Kong and also runs a fledgling TV business. This means that PCCW has a more diversified business portfolio for which some investors are willing to pay more because they see the prospect of future growth in the TV business. Expectations of future growth can be seen in PCCW's higher PEs over the past 3 years, which reached 60 times in August 2020 and March 2022, when the stock was obviously overbought. However, PCCWs are now trading at a PE which is more than 25% below its 3-year average, an extremely undervalued level in comparison to its own history. As for China Mobile, meanwhile, the China-based telecom operator focuses on mobile phone network and internet broadband services only. Therefore, the company is more like a stable utility stock, and that's why the PE is just about 7 times. Because of the very different businesses, it makes good sense for investors to look at the historical PE ratios of PCCW and China Mobile. From a historical perspective, China Mobile appears to be less attractive as its current PE is only at a 13.1% discount in comparison to its 3-year average. It would be too simplistic to merely look at the PE from a historical perspective, as there can be situations in which a stock has a large PE discount simply because its future earnings prospects are dim. This can create a value trap in which a stock looks undervalued but proceeds to demonstrate in the future that it was cheap for a reason. To avoid value traps, Magpie Research adopts a more sophisticated methodology to select value stocks. We examine not only a stock's PE discounts, but also other factors such as earnings growth, dividend yields, and share price volatility. If we also consider China Mobile's stronger earnings growth and lower share price volatility, China Mobile will be a better choice for investors amid the current market turbulence. Thank you for watching. I hope you enjoyed my presentation. See you next time.